Welcome to another episode of Sidekick TV. I'm your host, Rick Thorpe. In today's episode, we're joined by Paul Brobyn from Panda Mortgages, and he's talking to us about all the different options available for small businesses when it comes to commercial lending. If you enjoy this episode, please do like and subscribe. Thank you. So today we're going to be talking about the various types of lending that small business owners and self-employed people might be getting into for their business. And of course, there are many different types of this. So look, Paul, you're the expert on the subject. Please, can you kind of run us through a few things that you're thinking with this?
Yeah, sure thing, Rick. So there's obviously quite a lot of different types of loans that people have available from banks and other lenders. I guess the key thing is making sure that the type of loan fits what they want to borrow it for. So like running through the types of loans, we have basic mortgages, everyone knows them. We get a 30-year mortgage on our house because we need a lot of time to pay it off. It's a big loan, right? We have personal loans that people take out. Quite often they're unsecured, so they might be to cover some a holiday or some work in the garden or something small. There are asset finance loans, so buying a new vehicle or equipment sometimes as well. And then there are what we call standard business loans as well. So and a business loan, I guess the key difference there is that it's often shorter than, say, a mortgage is the key thing there. So they're the basics. On top of that, you also have like your facilities for like overdrafts and trade finance facilities and some other complex stuff, but that's the basics of it.
Because you've still, things like the revolving credits or lines of credit.
Yes, correct, yeah.
Even credit cards.
That's right, yes.
There's lots of debt out there, and
Definitely
it is a real minefield to, sorry, I've put you on the spot by getting to name every type of debt. Cool. So run us through, in your mind, because this conversation is really about fit for purpose, what can a small business owner do or get the most out of? So, what would be a typical scenario that you'd see?
So quite often what I see, and this is probably the opposite of fit for purpose, but I'll obviously come into it, is I'll meet a client who is maybe buying a business, right? So they need to borrow a reasonable amount of money to buy their business, and they have a house already, which is great. So the bank love you because you've got a house. Yeah. And then what they go is, that's great. I'll put that loan over 30 years and I'll pay that off over a 30-year term. And it's not really fit for purpose for buying the business because in a business loan, you want to be able to pay that off over a shorter period of time, probably about 5 years ideally, just because there'll be things that will come up in the business. You'll need to spend more money. There might be new assets that need to be done. Businesses go through rebrandings. There's lots of different reasons you'll need to put more capital into a business. If you have it over 30 years, you're never paying that loan off, and it just doesn't work, basically. So,
you never get the equity in the business, do you?
Right,
so, like you say, a big piece of machinery breaks and you're back to square one.
Back to square one again, yeah. And so I think most businesses should think about what will be their capital expenditure over the years, because they will need to buy something else. And even the most simplest of business will maybe need to buy a new laptop, for example, and things like that. So you want to be able to pay down that debt in a timely manner and be able to then grow the business and be able to borrow more funds into that. So the biggest mistake, I suppose, I see is the people wanting to get a 30-year home loan for their business. It doesn't mean they can't use a home loan. Clients can use a home loan product and pay that cheaper rate, and that's fine. It just is about structuring it in the correct way and making sure that it still fits the purpose that they need. So,
because that's it. It's often the most appealing type of debt to go and get because it's usually the cheapest. But you're right. Without the right advice on that, you might just be painting yourself into a corner.
That's right. Yeah. And I suppose one of the other things is not getting caught up on the type of loan. So I've just done one recently where someone's bought a business. There wasn't enough equity in their house to do a home loan. So they've done a pure business loan. So that interest rate is going to be higher than the home lending rate. So, for example, it might be 9.5%. I think floating rate's 8.75, so it's not far off that currently. But at the end of the day, the interest part of it, if they're borrowing for their business, is tax deductible, right? So as long as cash flow can maintain that, then the rate itself shouldn't get bogged down in the rate, right?
Yeah, totally. And I suppose the other thing is, like what Sidekick does with our clients that do this is, whether it's your mortgage or whether it's a pure business loan, well, actually, if the purpose for the loan was the purchase of the business, it's deductible anyway.
Yes.
So it's just a bit more of a faff about.
That's right, yeah.
But if we're talking, back to the good old days where 6 was normal, right? So you're looking at 6s or 8s.
Yeah.
In real terms, they're looking at 4s or 5s.
Correct.
So
that's right.
Yeah. Okay. On that note, you mentioned personal loans as an option. Now, this is where I see stuff go wrong all the time. People go get a 50 grand personal loan, which is a horrendous term, rate.
Yes.
Everything usually, and then we find out about it ages later because they didn't claim it back. And so what? How do you see people engaging with these kind of personal loans, but they're for business purposes?
I think it's easy to get a personal loan in most cases, right? So there are a lot of lenders out there that will give you a personal loan because it can be for any purpose, right? So they can be a little bit more loose, I suppose, on their reason for lending. And so what happens is, you're right, people go out and get a personal loan because it's simple and it's easy. They're paying the highest interest rate they probably can outside of a credit card. In some cases, I've seen personal loans higher than credit cards. So it's quite scary. And then because they've done it as a personal loan, they just think that's money they've got to pay back and not through the business. You're right. So if they'd have spoke to someone previously and maybe thought, okay, what's the purpose for? It's for my business. So a business loan is almost identical to a personal loan in some ways, but it's for the business. It means that you're doing the right things around tax that we talked about before, and it means you can structure it properly, because sometimes you get a personal loan over maybe 2 or 3 years. It's killing someone's money, right? And whereas a business loan, you might be able to put over 5 years, or it also might be to buy some equipment in their business, right? So that could have been an asset finance loan rather than a personal loan. So I think getting the advice there is key in that type of scenario. Basically,
Before you sign anything or buy anything.
Yes.
Usually, because it might be that you go, there's a better way of this, there's a better way of that, or
exactly.
Okay. This thing, credit cards, I sometimes see people using them really well.
Yes.
1 in 10. And that's probably generous. So, but they can be an amazing tool for a business.
Credit cards can be unbelievable. So, just me personally, I spend everything on my credit card, but then I pay it off at the end of every month, right? That's good. Banks don't like that because they're not making any money, right? But the credit card is, in most cases, you've got an interest-free period on the card, right? So
30 to 50 days.
Yeah, if you had an overdraft, you're paying interest on that straight away, right? If you are borrowing money, you're paying interest on that as per day one, whereas your credit card is interest-free for 30, 40, 50 days, depending on the card. So if you're good with it, it's a great way of doing things. I've had that conversation with clients in the past where we've discussed in length a couple of different options, and I had one who wanted to basically borrow some money for a very short period of time. They were selling an asset and it was going to be less than a month. And I said, have you got a credit card? Yeah. And I said, well, put it on the credit. They were trying to get a holiday, I think it was. I said, I wouldn't normally say this. Let me say that. I wouldn't normally say this, but I knew the client well. I said, put it on your credit card. By the time you've sold your car, you'll put the money back on your credit card, and then you won't have paid any interest. Whereas anything I help you with, you're going to pay interest on. So it's about managing things properly and knowing how they work and making sure you're on top of it, I suppose, is the key there. But they can be great.
And in a market like we're in at the minute, where you've got overdraft rates, which are easy, 13s, 14s.
Oh, easy, yes, sometimes higher. Yeah.
So if you've got 30 grand and you're using it to pay your suppliers and operating expenses monthly, and you're doing that on a credit card instead of an overdraft, you might save 4.5 grand a year. You might.
You also might get air points too.
Yeah.
Depending on your bank and depending on what sort of deals they have.
Yeah.
You may be able to put everything through that card, get some air points or whatever that bank is offering, and have that interest-free period. So you could save yourself a lot of money rather than just having an overdraft and paying for it on day one, right?
Yeah.
So, yeah.
The caveat to that is get it wrong and it might cost you 7.5.
Exactly.
Like, so,
that's true, yeah. And look, the key thing with that, I suppose, is look, most banks have the ability to set up a direct debit to clear a credit card. So, hey, set up a direct debit. Make sure the credit card limit is something you can live with. So, where people get caught out is they'll have a $30,000 credit card and then they'll just keep getting higher and higher and higher, right? And then they're paying 22% on 20 grand. And it's not affordable, right?
Totally.
But if you utilise it for a good purpose and utilise it properly, it can be a great tool, definitely.
Well, yeah. So, and that's the thing. It's often people are scared, and it's very easy to have a bad experience with a personal loan, with a personal credit card, with any number of other things like that, right? But you have those same tools in a business capacity, and actually, with the right disciplines and whatever, it can be a much better experience, hey?
Yes, it can. Yeah, it can be a really great experience if you're set up properly, if you know what you're doing, stick to what it is, and then go through the process. It can be really, really good. And there's nothing wrong with borrowing money either, right? So I meet clients quite a lot that have got a business to a great position and have never borrowed money, and then they think that it's a negative because they've got to then go and borrow money. You know, if you're a business that's constantly buying stock and selling it, there's nothing wrong with having an overdraft or utilising a credit card, and it helps your business grow if it's the right funding, right? So funding can be really good. It can be expensive, but if it's going to grow your business, then that's the key thing. And one of the things I often do with my clients is we'll talk about what it is they want to achieve and what the funding cost will be to make that achievement. So I had a client who was looking to expand overseas. They told me if they got this expansion overseas, it was probably going to return them another couple of $100,000 a year. It was their forecast. And they needed to borrow some money short term, well, not short term, they needed to borrow some money to make that expansion happen. And we came back and there wasn't very many assets, there wasn't any security, the business wasn't doing great. So it wasn't cheap lending, it was quite expensive. But the lending was probably going to cost them 50 to 100 grand. Their return was going to be 100 grand per year. So my question to them was, right, is it worthwhile spending 100 to then have a residual income of 100 per year? Which in my mind it was, but that was their choice at the end of the day. So and so sometimes you might go, oh, that is very expensive. Lending can be very expensive, but if you're getting a return on your lending, then that's fine, right?
Yeah,
that's the key thing is doing your numbers. On the flip side of that, you see sometimes people that borrow and borrow and borrow for the wrong, because they're trying to stay afloat or something like that, and then their hole's getting bigger and bigger and bigger, and that's the worst type of lending to do. So again, talk to the right people, and no one wants to hear that either. It's not great, but it's better to stop it early than to keep going down that sort of that hole.
I think we said that in the last video. It's around sometimes it's the difference between do you get to keep your house or not?
Yes,
because it can get so bad.
It can get that way. Yeah.
I'm just thinking with you'd mentioned something there about if you're buying and selling a lot of stock or what have you. Funnily enough, there's a mutual client of ours that I've just been sending back to you recently, and a major part of their business, and I think potentially the most complex part of their business is they buy big expensive stuff from overseas.
Yes.
In a foreign currency, and they import it here.
Yes.
Things like trade finance.
Yeah.
Perfect,
that's right.
So, in my experience, layman's terms, cheap, lock in the foreign exchange risk. Typically have the assets insured because they have to be while they're on the water. And you only need about half of the equity to go do the deals for growth.
Sometimes less. Trade finance can be an amazing tool, and not a lot of people know about it. So businesses think, how am I going to get that item from overseas, bring it here? And there's a process that can cover everything from locking in the rates to funding it to making sure, and you can have invoice finance on the end of trade finance sometimes as well. So you might be bringing in a product that's for commercial reasons. So you can actually sell on the invoice, basically. So you'll get paid for that. Use that funds to then go and pay for the invoice for the trade finance, and still have some money left over.
Yeah.
So
I have heard that invoice finance is more addictive than meth, though. It's harder to go cold turkey off invoice finance.
It is, definitely.
Yeah. Well, actually, do you know what? In this scenario, another great thing is because it'll be consumers that buy at the other end.
Yeah.
So it's more like they're just trying to get rid of that liability immediately and just pass it on to you. So then you can write the line. So, I mean, and this is it in this particular business. And this is why I care so much about doing these videos, right? Is that this business that I'm talking about here is such a beautiful business if the finance side is done right. You know, it's a potentially really tough business if the finance side of it isn't right.
Yeah.
And I wouldn't expect any business owner to know it all.
No.
Like, know enough to know what to ask.
Yes, definitely. And that's the key, right? Is talking to the people around you, getting the right advice is key, right? And then it's in most cases a simple mathematical equation, right? What's the cost to do it? What's the return? And if you work it out properly, then you can decide, is it or isn't it worthwhile? Or do we need to get some of our own capital to reduce our funding cost to make it more viable? Or do we just sell the item for more because the funding cost is more? You know. So things like that play in as well. Like we sometimes deal with people, builders, building houses, for example, and they say, "Oh, can we do a turnkey for this client rather than paying?" And it's like, you can, but then you're going to have to charge that client more because it's going to cost you to fund it yourself as opposed to them paying it. So it's working out those calculations to make sure that whatever your funding is for, it's fit for purpose and it works, and you get a return at the end of it.
And that is something that you're dead right. When we look at that with projections, with forecasts for clients, or if they're wanting to understand a bit better their margins on that turnkey home, you know, you're doing a spec build or what have you, it's like you might have $500,000 on a close to 10% interest or what have you, and you might have it for 9 months. I should have picked easy numbers for this. But that's going to cost you potentially about, what's that, 37 grand?
Yes.
Right. Well, more or less. It depends when you draw down the money. But it's like, you can't ignore that amount of money because that could be easily half of your actual margin. And so the other thing is when people think that they sell, I broke even on that. Well, no, you didn't because your interest costs put you in the hole.
That's right.
However much. So.
Yeah, and that's one we discuss quite a lot is that, and it's, so generally with builders, it's, I've got a client who wants to buy this house. We've agreed on a price. Now I want to do it as a turnkey. Well, then your price is out the window because it's costing you more to do it, right? And so the client has to pay for that. Unfortunately, that's how it comes down, right? So it's about working those numbers. And you're right, and it's not just a small amount because on an average house, you're talking at least probably 40, 50,000 once you pay for fees and interest and things like that. So it doesn't mean it can't work. It just means that the end user has to be willing to pay for that to make that work at the end of the day.
And I suppose it requires a totally different conversation with that end user so that they understand why it's so different. I'm funding it instead of you funding it, so it's costing me more. So you've now got to cover that cost, basically. So totally. Okay. And so we've covered off a lot here, right? So there's products, you know, like trade finance and credit cards you can use well, and personal loans, and using your mortgage and doing that better. Is there anything else you can think of that hits people hard when they're dealing with their finances like this?
Hits them hard. No, I just think not having the right setup is normally what hits people. Like you mentioned before, the personal loans, putting something over a 30-year term which shouldn't be also hits them. Doing the personal loan to maybe buy an asset is what I see a lot, which would, you'd be surprised the amount of assets you can get asset finance for, which reduces the cost because you've got something there, right? So most things with a serial number you can get asset finance on within reason. So that's something that catches people out quite a lot. And it's just really that thing of making sure you do have the right lending for what you want to do, and that's the key. So,
great. And so generally speak to someone, hey, You know,
exactly.
And the easiest money often wouldn't be the best.
No.
I would have thought. So, and like you say, has it got a serial number?
Yeah.
Has it got this? Yeah. Awesome. All right, great. Well, look, thank you very much, Paul. This has been really educational, and I hope you guys watching this have enjoyed it and learned. Those key takeaways, as always, speak to someone, get the advice, and just don't dive in instantly. So look, if you've liked this video, please do like and subscribe wherever you are watching or listening to this. I look forward to seeing you again. Cheers. Welcome to Sidekick TV. I'm your host, Rick Thorpe. Sidekick TV is the place for Kiwi business owners and entrepreneurs to learn all about finance, accounting, and how to run and operate a business in New Zealand. We're going to interview experts from the finance realm and fellow Kiwi business owners. Stay tuned.